In 2018, the United States accused Canada of being a national security threat. The accusation was never about security. It was an excuse decorated to impose tariffs designed to break Canadian manufacturing and force production back into the United States. What followed quietly reshaped Canada's alliances, pushed it toward partners labeled anti-Western, and exposed how economic power is actually exercised inside alliances. To understand what really happened, you have to start with the lie. Canada was not a threat to U.S. security. It was a NATO ally, a defense supplier, and one of the most integrated partners in U.S. military and industrial supply chains. Canadian steel and aluminum did not weaken American defense readiness. They strengthened it. Canadian inputs were already embedded in U.S. aircraft, vehicles, weapons systems, and infrastructure. Yet in 2018, the United States invoked Section 232 of its trade law, a provision reserved for moments when foreign imports genuinely threaten national defense. That clause bypasses normal trade rules. It bypasses the WTO. It bypasses ally exemptions. It cannot be appealed. Once invoked, it is absolute. This was not a trade negotiation. It was lawfare. Section 232 turned national security into a legal weapon, and Canada was the first ally to learn how dangerous that precedent was. The stated justification was protection of U.S. steel and aluminum capacity. The real incentive was something else entirely. The United States wanted to reindustrialize without raising taxes, without paying subsidies transparently, and without asking Congress for permission. Tariffs solved all three problems at once. They raised revenue without a tax vote, they punished foreign producers without budget appropriations, and they forced manufacturers to relocate or pay the price. This is the hidden function of tariffs that is almost never explained. Tariffs are not paid by foreign countries. They are paid by domestic importers. Those costs are passed to domestic manufacturers, retailers, and consumers. Tariffs are domestic tax collected quietly at the border, disguised as foreign punishment. In 2018, that tax was targeted. In 2025, it became systemic. But before we get to 2025, you need to understand what happened between 2018 and 2024, because that period is where the real damage was done. In the immediate aftermath of the 2018 tariffs, Canada responded the way allies are expected to respond. It protested diplomatically. It imposed retaliatory tariffs. It waited for normalization. And publicly, it was told that this was temporary. Privately, Canadian firms learned a different lesson. They learned that contracts could be voided retroactively. They learned that ally status offered no protection. They learned that national security could be declared at will, even against a partner with no hostile intent. That realization triggered a quiet but decisive shift. Canadian businesses stopped treating the United States as the default buyer, the default supplier, and the default legal jurisdiction. They did not announce this. They did not frame it ideologically. They simply rewrote contracts. Between 2018 and 2024, Canadian steel producers began signing longer-term supply agreements with European buyers, particularly in Germany, the Netherlands, and Italy. Steel that had historically flowed south, as swing volume now flowed east under fixed terms. By the early 2020s, Canadian steel exports to the European Union had grown from roughly $5 to $6 billion annually to closer to $8 billion, and those volumes were locked, not opportunistic. The same shift occurred in aluminum. Canadian aluminum producers reduced exposure to U.S. Midwest pricing premiums and moved toward London Metal Exchange benchmarks with regional add-ons tied to Europe and East Asia. This reduced tariff exposure and removed the risk of sudden reclassification. In agriculture, the pattern was even clearer. Before 2018, the United States was the default destination for Canadian canola, soy, and processed agricultural products. After 2018, incremental output stopped flowing south. New acreage increases went to China, Vietnam, Indonesia, and other Asian markets willing to sign predictable contracts. By the mid-2020s, Canadian canola exports to China alone ranged between $7 and $9 billion annually, depending on the year, while U.S. volumes stagnated. This was not political alignment. It was risk management. China did not invoke surprise security tariffs against Canada. It negotiated, regulated, and enforced contracts within known parameters. That made it more reliable than an ally that could change the rules overnight. Potash tells the same story, but more decisively. Before 2025, the United States absorbed a significant share of Canadian potash exports, often through spot or short-term arrangements. After 2025, Canada signed multi-year, 5 to 10-year potash contracts with India and China, each absorbing roughly $3 to $4 billion annually. Those contracts were priced outside U.S. benchmarks, arbitrated outside U.S. jurisdictions, and structured to survive political shocks. Once signed, those volumes did not come back. Uranium followed the same path. Before 2025, the United States accounted for roughly 35 to 40% of Canadian uranium exports. After 2025, new long-term contracts skewed toward Japan and South Korea, supplying roughly a quarter of Japan's uranium imports and $1 to $2 billion annually to Korea. Again, this was not ideology. It was energy security without tariff risk. On the import side, the changes were just as stark and far more consequential. Before 2025, Canadian manufacturers imported the bulk of their machinery, tooling, auto components, and electrical equipment from the United States. After 2025, that assumption broke. Canadian firms redirected an estimated $12 to $18 billion per year in manufacturing imports away from U.S. suppliers and toward Germany, Japan, and South Korea. The reason was simple. If tariffs could be imposed on exports, they could be imposed on inputs. Border friction was no longer theoretical. Companies chose slightly higher sticker prices in exchange for certainty. This is the psychological break most people miss. Before 2018, firms assumed U.S. trade friction was unthinkable. After 2025, they assumed it was inevitable. That difference changes everything. Now we get to 2025, the year the system stopped pretending. In 2025, the United States expanded tariffs beyond metals and into batteries, electric vehicles, critical minerals, and broad categories of manufactured goods. This was not a negotiation tactic. It was a posture. The justification again invoked security, supply chain resilience, and domestic capability. The effect was clear. Tariffs stopped being temporary pressure and became permanent policy. At that point, Canada stopped waiting for normalization. After 2025, Canada's trade policy stopped optimizing for efficiency and started optimizing for optionality. New export growth did not go to the United States. It went elsewhere. New capital did not assume U.S. legal primacy. It's structured around it. Infrastructure investment followed trade. Post-2025, Canada saw $10 to $15 billion in incremental investment from Middle Eastern and Asian capital into ports, logistics, energy terminals, and rail. This capital was not values-based. It was contract-based. It did not threaten retroactive penalties. It did not invoke national security clauses. It honored deals as written. This is why Canada's new partners are often labeled anti-Western. Not because they are ideologically aligned, but because they are transactionally consistent. The United States did not lose Canada as a trading partner. It lost Canada as a trusted default. This is where the hidden function of tariffs becomes unavoidable. Tariffs are a tax on domestic consumers. In the United States, importers pay tariffs. Those costs are passed through supply chains. Manufacturers pay more, retailers pay more, consumers pay more. The U.S. Treasury collects revenue without raising income taxes. Politicians avoid votes. Blame is shifted to foreigners. This is the same logic as inflation through monetary expansion. Costs are diffused. Responsibility is obscured. In the short term, some groups benefit. Domestic steel producers enjoy protection. Politicians win elections. The Treasury collects revenue. In the long term, the damage accumulates. Consumers face higher prices. Small manufacturers lose competitiveness. Allies diversify away. Trust erodes. This is the unintended consequence the system cannot reverse. Once trade is weaponized, redundancy replaces efficiency. Once redundancy replaces efficiency, prices rise permanently. Who won in the short term? U.S. protected industries, lobbyists, politicians who avoided tax votes. Who lost in the short term? Canadian manufacturers exposed to the U.S. market, U.S. consumers paying higher prices, firms dependent on cross-border just-in-time supply chains. Who wins in the long term? Countries that diversified early, firms that priced in political risk, capital that moved toward predictable jurisdictions. Who loses in the long term? Consumers everywhere, workers caught in transition, alliance credibility. Is reconciliation possible? Politically, yes. Structurally, no. Once an ally weaponizes trade law against another ally, the precedent is permanent. Canada will not re-centralize supply chains through the United States. Europe will not either. Japan and Korea are watching closely. If it happened to Canada, it can happen to anyone. Now comes the part that matters most. What this means for people, businesses, and investors. For Canadian businesses, the opportunity is not in restoring U.S. access. It is in serving non-U.S. buyers who value contract certainty. Industrials tied to Europe and Asia gain relevance. Logistics firms connected to Atlantic and Pacific ports gain leverage. Energy and resource producers benefit from long-term non-U.S. contracts. For Canadian investors, U.S.-centric exporters carry structural risk. Firms with diversified export destinations, non-USD pricing, and non-US CES arbitration clauses are better positioned. For U.S. businesses, protected industries gain temporarily. Downstream manufacturers lose competitiveness. Import-dependent firms face margin compression. For U.S. investors, tariffs favor upstream producers and punish consumers, retailers, and margin-thin manufacturers. Sectors tied to domestic production gain. Sectors tied to global efficiency decay. The gap this creates is exploitable. Cross-border arbitrage, logistics rerouting, contract restructuring, and regional specialization become profit centers. Markets fragment, intermediaries thrive. The final arc is simple. The United States used power against an ally. The ally adapted. Power does not restore trust. It forces alternatives. That is the lesson of 2018. That is the confirmation of 2025. And once alliances are treated as leverage, they stop being alliances at all.